Hello, my name is Sebastian Gay, CBO's Assistant Director for Financial Analysis.
And I'm Michael Falkenheim, a Senior Advisor in the Financial Analysis Division.
Today, we're going to provide an overview of CBO's report, Financial Regulation, and the Federal Budget. Financial regulation affects the federal budget directly and indirectly. Directly through spending for programs that support the stability of financial institutions and through the taxes and fees that those institutions pay, and indirectly through its effects on the economy. Regulation's economic effects generate a trade-off. Increased regulation may lower the likelihood of a financial crisis and mitigate the severity of any crisis that occurred, but it may also raise the cost of financing for investments and slow economic growth. Such economic changes, in turn, affect revenues and spending. CBO refers to those indirect effects on the budget as macroeconomic feedback.
Federal financial regulation generally falls into three categories: safety and soundness regulation, guarantee lending and resolution authorities, and consumer and investor protection. The goal of safety and soundness regulation is to support financial stability and protect households and businesses who place their savings in the financial system. It achieves that by limiting the kind of risk that financial institutions, such as banks, can take. One example of safety and soundness regulation is minimum capital requirements, which require that banks and other depository institutions finance a minimum fraction of their assets with capital, such as shareholders' investments, as opposed to funds that need to be repaid. When a bank finances more of its assets with capital, it decreases the risk of being unable to repay its debts. One potential unintended consequence of such regulation is that it can inhibit activities that would benefit the economy and that pose little risk. To examine the effects of changes in safety and soundness regulation, we analyzed an illustrative policy that would lower banks' capital requirements by 1 percentage point. In other words, banks would be able to finance a larger portion of their assets with debt, which might lower their costs in an average year, but increase their risk of failure. The second category of regulations, resolution and guarantee authorities, mostly reside with the Federal Deposit Insurance Corporation, or FDIC. The FDIC runs the Federal Deposit Insurance Program, which was established in 1933 to prevent bank runs. That program guarantees bank deposits up to a specified limit. In 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act expanded the FDIC's authority by vesting the agency with orderly liquidation authority. That authority allows the FDIC to provide financial support to banks and other financial institutions when the stability of the financial system is at stake. Those programs can prevent the failure of one or a few institutions from creating a crisis in the financial system and the broader economy. But they have a potential downside. Because the government shares the costs when things go wrong, the programs might encourage institutions to take excessive risks. To examine the effects of changing resolution and guarantee authorities, we analyzed an illustrative policy that would eliminate orderly liquidation authority. The third category includes policies that prohibit or discourage practices that might harm consumers or investors. These are rules that require businesses to file financial disclosures and that prohibit fraud to protect investors. An example of a rule that protects consumers is the ability to repay rule, which was established by the Dodd-Frank Act. It requires that lenders make a good faith determination that borrowers can repay mortgages before lending to them. Although those rules are intended to help consumers, they run the risk of prohibiting or discouraging products that could benefit consumers. The illustrative policy that we analyzed for this category would repeal the ability to repay mortgage rule. CBO estimates the total effects of financial regulation on the budget as the sum of three effects: the direct effects and two types of macroeconomic feedback. The direct effects refer primarily to the changes in the cash flows of the FDIC. For this analysis, we've distinguished between two kinds of macroeconomic feedback. Under the baseline conditions in CBO's economic forecast, less regulation would reduce the cost of financing investments and increase GDP. But less regulation might also increase the likelihood and severity of a financial crisis, and if such a crisis occurred, GDP would fall rapidly. For each illustrative policy, we first estimated the feedback from the effects of the policy on GDP and other economic variables in a typical year, and then we estimated the feedback stemming from the policy's effects on the likelihood and severity of financial crises. Now Sebastian will preview the main results from the report.
Here, we can see that the macroeconomic feedback from the three illustrative policies is projected to be much greater than the direct budgetary effects. The key finding here is that financial regulation affects the budget mostly indirectly through its effects on the economy. We will also see that the estimates of the macroeconomic feedback are very uncertain. In this slide, we can see that bank failures have been heavily concentrated in just a few years, and that episodes of many failures can occur right after periods of low rates or even no failures. CBO's projections incorporate a high probability of a year with almost no failures and a low probability of a year with many failures. CBO's projection for the FDIC, like its projections of all government activities, cover 10 years. It is important to understand a couple of things about the FDIC. First, the Congress designed the FDIC to be self-sufficient. That is, the agency should cover the cost of deposit insurance by charging premiums to the banks. If it ever needs to use orderly liquidation authority, the agency will recoup its costs through assessments on large financial institutions. Second, projections of losses to the FDIC programs are very uncertain because projections of economic conditions are highly uncertain. As I mentioned, we do not project the direct effects of the three policy changes in the report to be large. In fact, our estimates for two of the policies are close enough to zero over 10 years that we represent them here with an asterisk. We anticipate that lowering capital requirements or eliminating the ability to repay rule would increase bank failures somewhat. The increased cost of those bank failures would be offset with higher premiums. Therefore, the resulting effect on the federal budget is a wash. Eliminating orderly liquidation authority would have a slightly larger direct effect over 10 years. In CBO's baseline, spending for the orderly liquidation fund is projected to be approximately $20 billion. That amount should be seen as a probability-weighted estimate of different outcomes, where there is a small chance of a big expenditure and a large probability of no expenditure at all. If a large expenditure did occur, the FDIC would try to recover the money by selling that failing institution's assets and setting fees to recoup the money. That recoupment would not occur entirely within the 10-year projection period. So orderly liquidation authority has a budgetary cost in the 10-year projection period. Eliminating that authority would eliminate that cost. All of these estimates are subject to considerable uncertainty because they rely on assessments of how the financial system would change in response to the changes in policy. I will talk more about uncertainty later.
Let's now turn to the economic effects of financial regulation under baseline conditions where the financial system is stable. In that case, lowering capital requirements or repealing the ability to repay rules allows more credit to flow, and that boosts GDP, as shown in this slide. In this figure, we see the other feedback effect. When financial regulations are looser, there is a higher likelihood of a financial crisis like the one that we experienced from 2007 to 2009, and that crisis did a lot of damage to the economy. This slide shows how the crisis affected GDP under CBO's estimates. It also shows the potential level of GDP, which is CBO's estimate of the maximum sustainable level of GDP for the economy. As you can see, GDP fell below its potential level during the 2007 to 2009 crisis and took years to recover. We use the 2007 to 2009 crisis as a model of what a future crisis might look like, as shown in this slide. The top line represents our baseline projection of GDP from CBO's January 2019 Budget and Economic Outlook. Each of the lines hanging down from it represents a scenario where a crisis occurs in each of the years of our projection. The first one shows what GDP would be if a crisis began in 2020. And then we have a separate projection for a crisis starting in each of the following years. We have a 1.5% chance of a crisis occurring in each of the years of the projection period, based on historical data on the frequency of financial crises in the United States and other advanced countries. To estimate the effect of policies, we assumed that the probability of a crisis occurring in each period, which is 1.5% in our baseline estimates, would change. Specifically, CBO projects that lowering capital requirements would increase the probability of a crisis from 1.5% to 1.8%, or an increase of 20%. And repealing ability to repay would raise that probability by much less, from 1.5 to 1.52%. We also created a projection of a more severe crisis to represent what might happen if federal authorities were unable to contain a crisis once it occurred. In the 2007 to 2009 crisis, the Federal Reserve used its authorities under the law at that time to keep financial instability from spreading from one institution to another. The Dodd-Frank Act replaced many of those authorities with orderly liquidation authority. If orderly liquidation authority were eliminated, then the government would have fewer tools than it did during the 2007 to 2009 period to contain a crisis, and the result would be a much more severe crisis than what we experienced in at least some situations. Specifically, we project there to be a 1 in 200 chance each year for there to be a crisis that would need something like the orderly liquidation authority to contain it. This slide shows that the effect of this more severe crisis on GDP is about double that of the benchmark crisis. In the previous slides, we spoke about the economic effects of financial regulation in two categories: effects under baseline economic conditions and effects in a crisis. This slide shows macroeconomic feedback under baseline economic conditions, or under an average sort of economy. The increase in GDP for both lowering capital requirements and repealing the ability to repay rules would boost tax revenue, but lower capital requirements would have a more than offsetting effect on tax revenue because of its effects on the financing mix of banks and other depository institutions. Lower capital requirements allow banks to finance a larger portion of their assets with debt, which has a tax preference. Banks can deduct the interest on debt from their gross income. Lower capital requirements allow banks to use more debt and thus take greater advantage of this tax deduction. So although lower capital requirements lead to higher GDP and more tax revenue for that reason, the change in the financing mix lowers revenue by more than an offsetting amount. This slide shows the second kind of feedback effect, the kind that comes from changes in the likelihood and severity of crises. Raising the likelihood or severity of crises, as these policies would do, would have very large effects on tax revenue, as shown in the revenue line in this slide. The main way that the 2007 to 2009 crisis affected the budget was through a very large drop in tax revenue, and our projections here reflect that pattern. Financial crises do not have large effects on non-interest outlays in these projections, although they lead to higher spending in unemployment insurance, food stamps, and Medicaid, as well as other safety net programs. They also shrink government spending in other ways because of their effect on the economy. For example, the spending in programs linked to inflation will be lower after a financial crisis because inflation will be low. We project interest rates on Treasury securities to drop in a future crisis following their pattern in the 2007 to 2009 crisis. That will result in lower interest payments that will partially offset the increase in the deficit that results from lower tax revenue and higher non-interest spending.
One thing I mentioned earlier in the presentation that I want to emphasize is the high level of uncertainty in these estimates. The graphs in this slide capture that uncertainty. The analysis required numerous assessments about how participants in financial markets might react to policy changes and how the changes in behavior would affect the economy. The probability of a financial crisis is difficult to estimate. To establish the parameters used in this analysis, CBO drew on academic literature whenever it was available. That academic research has produced a wide range of plausible estimates. To communicate the high level of uncertainty, we identified 8 key parameters, and we recalculated all of our results with alternative parameters that were used in academic research. Or, to be more precise, we wrote a computer program in Python to cycle through every possible combination of those parameters and recalculate our results for us. The figures on this slide show the range of results we got from this process, both in terms of dollars and as the percentage differences between those estimates and our central estimates. They show, for example, that under alternative parameters, the macroeconomic feedback associated with eliminating orderly liquidation authority could be more than double what we estimate, or even have the opposite sign of our estimate. In addition to publishing the report, we also developed an interactive tool that allows users to change the values for key parameters and see how those changes affect the projections. The report, tool, and code are all available on CBO's website. If you have any questions about our analysis, send us an email at communications@cbo.gov.